We usually think of crypto as this big global thing, right? But what happens when it runs into the very specific economic forces of a single country? Well, today, we're diving into some fascinating research out of Indonesia that shows how local factors can totally flip the script on risk and reward. When you picture crypto, especially in an emerging market, you might think of the Wild West, totally unregulated, a free-for-all. But is that actually what's happening in a place like Indonesia? Well, here's our first surprise. In Indonesia, it's not the Wild West at all. Cryptocurrency trading is actually licensed and regulated. Yeah, it's overseen by Bapepti, which is their commodity futures agency. So this is a structured market, and that completely changes the game for investors. Okay, so here's our game plan. First, we're going to see just how massive Indonesia's crypto scene really is. Then we'll get into the nuts and bolts of the research itself. After that, we'll hit the 3 key findings that kind of turn what you'd expect on its head. And finally, we'll talk about why any of this actually matters. So let's set the stage. How big are we talking here? What did the Indonesian crypto market actually look like back in 2021 when this study was happening? Just to give you some perspective, this was no small-time operation. A single exchange, Indodex, had already racked up over 1.3 million users. So we're talking about a seriously active and pretty significant pool of investors. Okay, so with a market that big, how in the world did these researchers figure out what was really driving risk and return? Let's get into their methodology. So the researchers kept things really focused. They looked at the 5 big-name cryptos during a 9-month window in 2021. And, in the crypto world, 9 months can feel like an eternity, so this is a really concentrated look. They used a pretty standard statistical method to comb through all the monthly transaction data, basically hunting for patterns between different risk factors and what investors were actually making. So after all that digging, what did they find? This is where it gets super interesting. The research zeroed in on 3 key things that were consistently dragging down crypto returns. Let's break them down one by one. First up, we've got something called beta. Now, don't let the financial jargon scare you. All it means is how much does an asset jump around compared to the rest of the market. So a crypto with a high beta is just more volatile. It has bigger price swings, up and down. And here's where things get really weird. This finding just flips the whole high-risk, high-reward idea on its head. The study found that the coins with a higher beta, the riskier ones, were actually linked to lower returns. And what's wild is, the researchers noted this isn't totally out of left field. They've seen similar stuff in the Indonesian stock market, which suggests some unique local market dynamics are really at play here. Okay, factor number 2, the local currency exchange rate. For an investor in Indonesia, this is a big deal. It's basically how many rupiah it costs them to get the US dollars they need to then go and buy crypto. Now this one makes a bit more sense. When the local currency, the rupiah, got weaker, meaning it cost more to buy those US dollars, crypto returns for local investors went down. Why? Well, their purchasing power just got kneecapped. It simply cost them more of their own money to get into the game, and that just eats away at any potential profits. And the third and final risk factor is one we're all a bit too familiar with lately: inflation. The rate at which your money just doesn't buy as much as it used to because prices are going up. And yep, you guessed it, another negative link. Higher inflation was also associated with slightly lower crypto returns. This might be more of an indirect thing, where rising inflation is a red flag for the whole economy, which might make investors a little less eager to jump into riskier assets like crypto. Okay, so we've got our 3 negative forces: beta, the exchange rate, and inflation. But the researchers asked another really smart question. Does the speed of trading, what they call velocity, change the impact of any of these risks? The answer they got back from the data was, well, it was pretty blunt. A clear no. The speed just didn't seem to make a difference. So let's just break that down. Velocity is just how fast crypto is being bought and sold. The researchers wanted to see if a faster pace made those other risk factors better or worse. But for all 3, risk, exchange rate, and inflation, the answer was the same. Trading speed didn't change the fundamental drag that those factors were creating. So, after all that number crunching, what's the big takeaway? Why should we care about a single study looking at a 9-month window in Indonesia? The story this research tells is actually pretty simple. For Indonesian crypto investors during this time, more risk did not equal more reward, period. On top of that, a weak local currency and rising inflation both chipped away at their returns. But the real lesson here isn't just about these specific factors. It's that context is everything. This is a powerful reminder that even for a so-called global asset, the economic realities on the ground can completely change the rules of the game. It really boils down to this clash, the interplay between the global idea of crypto and the very real, very specific economic conditions happening right there in one country. Which leaves us with a massive question for the future of crypto. If local factors like currency weakness and inflation can have such a direct negative hit, what does that really mean for building long-term strategies in emerging markets? Is crypto truly a global escape, or is it always, in some way, tied to the economy right outside your door?